QQQ has been an investing staple for people who have wanted to add growth and technology to their portfolio for the past few decades. QQQ tracks the top 100 stocks in the Nasdaq, excluding financial stocks, and it has made for a potent growth tech ETF. This is evident by its year-to-date performance because, as you can see, it is up 40%, which has been fueled by the AI and tech-driven hype train. There are alternatives to QQQ such as VUG and XLK, but one that stands out is QQM. The reason it stands out is because, on paper, it is almost the identical ETF to QQQ dished out by the same exact company. No, that isn't a mistake. I am fully serious. Invesco offers two quote-unquote different ETFs, both which track the Nasdaq Top 100. That's why in this video, I'm going to explain the minute differences between the two ETFs and give my advice for which one is better for you, because over the long term, they might not be so similar after all. I will also be explaining the QQQJ ETF later in this video, as it is another Nasdaq ETF offered by Invesco that can be confusing, so stick around for that as well. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. Let's quickly explain what QQQ is again in order to paint the picture. QQQ is an ETF that tracks the Nasdaq Top 100, but it doesn't actually include financial stocks. It's been a great ETF for investors who want more tech and growth but are unsure which exact stocks to buy. Now, here's the question. What the hell is QQQM? QQQM is the same ETF. It tracks the Nasdaq Top 100, excluding financial stocks, and you can tell that these are almost the same because the performance of these ETFs are nearly identical. However, there are some marginal differences in the weighting, which has resulted in QQQM having just a tad bit higher dividend than QQQ as well as a tad bit different results. But that's quite small and isn't guaranteed to stay that way. QQQM also trades at a lower price, and even though that doesn't actually matter as it tracks the same companies, it does make it so you can pick up more shares, which makes it easier to see the dividend drip over time. Dividend investing is a mental game just as much as it is anything else, and since dividends can take such a long time, small stock increases when you get paid can be mentally frustrating, so the stock being cheaper, in my opinion, is slightly better because of that. The biggest difference, however, and really the only real one, is the expense ratio. As I've mentioned before on this channel, an expense ratio is a fee that ETFs charge to cover their costs, such as advertising. The higher the expense ratio, the worse, as it chips into your growth over time. That is why QQQM is actually better. QQQM has an expense ratio of 0.15%, while QQQ has an expense ratio of 0.2%. If you were to invest 100 grand into both ETFs, QQQM would only charge you $150 a year, while QQQ would charge you $200. This difference is marginal, but even so, why not go with QQM as it is literally just cheaper? However, this also begs the question about why QQQM even exists. Well, one reason is that institutional investors, aka hedge fund managers and people like Warren Buffett, prefer ETFs that are traded more often with more liquidity, so they would probably prefer QQQ. For people like us though, this really does not matter, so QQQM is the right choice. However, if you are already invested in QQQ, it may be a different story. If you've been invested in QQQ for a long time, it will simply not be worth selling to switch to QQQM. The tax you have to pay on these capital gains simply isn't worth it, and it will make it so your new investment is now a short-term position again, meaning even more taxes if you were to sell that within a year. Long story short, invest in QQQM because it is just cheaper, but if you are already in QQQ, it depends on your situation with the ETF. Now, let's briefly talk about QQQJ, the smallest brother of the three ETFs. This ETF, unlike the other two, isn't some identical twin, it really is different. QQQJ is the next gen 100 ETF, which means it is the next 100 stocks outside of the stocks in QQQ. A good way to think of QQQJ is as the Nasdaq Tech 101 through 200 instead of the Nasdaq 1 through 100. ETF currently is the highest dividend yield of the three, and you will get a little bit more exposure to smaller companies with potentially larger upside. To show this, the biggest company in QQQJ has a market cap of just $28 billion, while the largest company in QQQQ has a market cap of almost $3 trillion, that being Apple. However, since the companies in this ETF are possibly less established, it could also prove to be an ill investment. We don't really know though, as QQQJ has only been around since 2020, so the information we have is extremely limited. However, if you think holding potentially next-gen stocks is a good idea, then this ETF might be for you, and it also has an expense ratio of just 0.15%, which is the same as QQQM. In total, all three of these ETFs are growth funds, and for older dividend investors, probably aren't the right play for you. However, for younger investors who don't necessarily need dividends to pay for anything and also have a much longer time frame, all three of these ETFs could prove to be worth it. If I had to recommend one, I would recommend QQQM, and it is a position that I have been eyeing recently and might actually buy, but you guys will know if that actually happens in my next portfolio update video. I hope this makes it clear around these ETFs because when I looked at them for the first time, I know it was a bit confusing for me. Thanks for watching. Goodbye.